Yeah. So when I got started in real estate investing, I didn't know anything about the numbers or the math, how to make it work. And so my question was constantly, how do I figure out how to do the math on these things? How do I figure out how to do the math on a single family, or how do I figure out how to do the math on small multifamilies and stuff like that? And the biggest thing is I never had the confidence, right? It seemed like it took me forever to build the confidence that this is the actual right way to do the math. And so what I did to get that confidence is I'd always be on YouTube watching other people or trying to find other people who actually were in the real estate game day in, day out, were buying it at big scales, that knew their math. And basically, I wanted to like shadow them, right? But I didn't have direct access to them because most of these people are busy and they value their time a lot, and they're not gonna, take time out of their day to talk to just anybody. So the ones that would put that stuff on YouTube and go through how to do the math, I mean, it was super valuable. So that is why I'm doing this today. I now, I run this company called Prospective Capital. We have hundreds of units. I have people who invest in the real estate that I do, that trust me and believe in what I'm doing. They trust that I'm going to do the math right and then I'm going to operate them right. And so basically, what we're doing, or what I'm doing here right now, and what you're watching on YouTube is like getting on a conference call. Okay. Every week in my business, we have conference calls with our operations team. We have conference calls just between the partners. And we go over the exact same stuff, very, very similar stuff to what we're going over here right now. So I'm doing this to allow other people to basically be able to shadow what we're doing and sit in on these meetings or sit in on these concepts and to learn from me without having to get on the phone and call me up. Now, there might be a way that you can call me up and you can learn more and stuff like that. But dude, learn from this, and hopefully this will be a very helpful resource for you. That's why I'm doing this and taking time out of my Saturday to do this, to have a conference call and include you in on this conference call. Now it's just going to be you and I right now on this conference call, nobody else. So you're going to get my full attention. But let me share my screen with you. Got this fancy slide put together. So fancy, so original. Look at that. Real estate investing, right? And today we're talking about math. How do you do the math on real estate deals? How do you know if you're doing the math right? What's it look like? I'm going to walk you through how I started, literally how I started from the very, very beginning, day one, when I knew nothing. And then I'm going to show you the math that I discovered that changed everything for me, that got me to the next level. That's probably going to get you to the next level. And we'll go from there. So who am I? I'm Steven Speck. I'm one of the managing partners here at Prospective Capital. We buy hundreds of apartments, and we allow people to invest with us in doing so. And so that's why I guess I know what I'm talking about a little bit. So, the first and foremost, what's most important is you ask yourself, why real estate, right? So if you're discovering real estate just because you saw it on TikTok and it's a get rich quick idea, that might not be the right way, or might not be the best reason to be in real estate, because it is business. It is business. When you buy a rental property, whether it's a single family rental or whether it's small multifamily, it is a business. You are serving customers. Your customers are the tenants, and you're responsible for that. Um, a lot of times, this is their home. They might not be transitory tenants, just need a place to stay for a little bit, a couple of years or something like that. But even more so now in today's environment of buying a house in the United States, people are becoming lifetime renters. So this is people's homes. So you got to be really committed to being in the game of real estate and know that that's the game you want to play. And so that's why I say, why do you want to be in real estate? Why? Make sure you have a good answer for that. For me, I always wanted to own my own business. I didn't really know what that looked like, but I got into investing first in the stock market. I learned how to do what's called discounted cash flow analysis, true fundamental valuations, the same stuff that you hear, whether it's investment bankers, private equity, Warren Buffett, Charlie Munger. That's the type of analysis or the way that they look at companies. I learned how to do that stuff, and then I transitioned to real estate because it fit into that model. But I still didn't know the numbers on how do you look at real estate specifically. So that brings us to the second point. You have to know how to do the math. It comes down to just knowing how to do the math. Honestly, that's like 80% of it, and then the other 20% is the art. The art is knowing how to look at a property and knowing, okay, how much is it going to deviate from what it says on paper? Okay, is this the area that I want to be? You can change a lot about properties, but you can't change the area. Okay, not very easily, at least. And you certainly can't change the area when you're buying apartment complexes or huge industrial sites. I mean, you can't change the area, so you got to know that stuff on top of the math. So yeah, where do you want to own? You got to know that. And then how much time do you want to commit to it? Like I said, if this is a get rich quick scheme, I don't think real estate's your game. To be honest with you, but if you're willing to commit 10 years to investing in this before you see this just huge return, that's the mindset you need to be in. And honestly, 10 years is not that much time. It's going to go by anyways. So if you're willing to commit 10 years, uh, real estate's probably the game that you want to take a look at. Okay. So that's maybe an investment perspective of how much time do you want to commit to it. But another way to say, or another way to look at it is how much time on an hourly basis every week do I want to commit to it? Okay. Because you're going to take a lot of time, especially in today's market, figuring out how do I find the deal. Finding the deal is the first thing in the order of sequences of things that you need to know. If you don't have a deal, everything else is irrelevant. Okay. But getting access to those deals takes time, takes relationships, it takes knowledge, which takes time to acquire. And it's not going to be something you can do just 1 or 2 hours a week realistically and be very successful with it. Okay. And a lot of people that I've talked to realize that, or they start to realize that after they do some research and investigating into it. And that's honestly why a lot of people partner with us. But if you want to do it on your own, happy to help you out doing it on your own and putting these videos together for you and walking you through different things. So yeah, acquiring a property, that takes time. Then managing the property. If you are starting out on your own and you're thinking about buying a single family house, a small multi, something like that, most likely you are going to have to manage the property on your own, which takes time. So if you have a full-time job, 40-hour a week, you're gonna have to go find tenants, run some ads. Then you got to screen tenants. Okay. You don't want to take the first person necessarily that wants to rent your property. You want to look through them. Okay. And that takes time, also takes experience, and takes a lot of looking through, a lot of seat time and looking at different applications to figure out who's going to be a good tenant, who's going to be a bad tenant. One bad tenant, if you have just a few units, can cost you a lot of money. They can cost you an entire year's worth of profit because they tear up your property. So definitely need to take your time and learn and understand how to screen tenants. The reason I say this is just to impress upon you uh, the understanding that real estate is more complicated than just buying a stock on TD Ameritrade. Okay, it's more complicated than buying a share of Microsoft or Nvidia or whatever the hot stock is of today, because you're actually buying a business. Okay, and that takes relationships and a lot of extra time. So make sure these are questions that you're asking yourself along the way. And if you want to play the game of real estate, but you don't want to commit the time to it, there are ways to get around that. There are ways to get answers for all of the questions that we just went through. If there's a hindrance in anything, if you don't know how to do the math and you don't want to commit the time to learning how to do the math, partner with somebody who does. Okay. Or take enough time to learn the basics and to know the important questions to ask on the math so you can tell if somebody's blowing smoke or not, and then go partner with somebody who does. Okay. That's just a way. I'm not saying that's what you should do. It's just a way. But odds are you're here to learn about doing the math. So when it comes to doing the math on real estate, let's take our first example of just a single family house. So let's say we have a house that we think rents for $700 a month. It's per month. And I ask you the question, how much is that worth? how much is a house worth that rents for 700 bucks a month? Just on a rental rental property perspective. How much is it worth? Now, you might ask some other questions. You might be like, what's the neighborhood like that I'm buying it in? What are comparable rents around that? Okay, if this house is renting for 700 bucks a month, and this is just a random number that I picked, what are other rental houses in the area renting for? Good question. Um, where is it located? You might ask something about cap rates. Okay. But if I ask you how much or what is the value of a rental house that rents for 700 bucks a month, and we just, you know, ceteris paribus, we just, everything else being equal, we're not paying attention to the comps. We're not to that point yet. How much is it worth? Here's how you figure that out. Take $700 a month. You multiply this by 50%. You're going to say 50% of what I collect is going to go to expenses. Okay, so you're left with $350 per month. Okay, you're going to multiply that by 12. So $350 a month times 12. That's going to give you $4,200 a year. Oh, okay, and then you're going to divide by the interest rate or the amount of money, the return on your investment that you want to make. So if I want to make 5% on my money, I'm going to divide by 0.05. So divide that by 0.05. And this means this house is worth $84,000. Okay. $84,000 in that example. And this number right here, when I mentioned something earlier that said cap rate, that's what a cap rate is. What that means is if I invested $84,000 cash for this property that's doing 700 bucks a month, and I wanted a 5% return, that's how much 84,000 is how much this house is worth to me. Okay. This is the basic math, back of the napkin math that works or is a premise of all real estate investing. Now, I'd say don't get caught up in the minutia just yet. Don't get caught up in, 700 bucks a month for a house. What rents for 700 bucks a month for a house? It's just a placeholder. Okay. It's the mechanics that we're worried about. So let me walk you through where I started when I was first getting involved in real estate and what it literally looked like, what I literally did. Okay. So when I first started getting interested in real estate, I didn't know very much. And I was, I think, a sophomore or junior in university going to Ohio State, which is in Columbus, Ohio. So I got on something, either Zillow or Realtor app, something like this, hit search, because you need to find the deal. So you need to know the websites to go to find the deal, and we'll talk about what websites or where you can go to find deals. Maybe it's not a website, maybe it's a person. Okay. In this case, when you're getting started out and you just need to do a lot of this running through numbers and learning that, I recommend, finding stuff that's easy to find, using realtor.com, using Zillow, using stuff like that, just so you can find properties to run the numbers and start learning and reinforcing how it works. So when I was just getting started, I was looking at houses. Obviously, I was going to Ohio State, so we're looking in the university district. And what I would do is I'd look for something that was cheap. Why? Because I was worried about how much money I had. How can I buy something if I only have $50,000 put down? Okay, then I can probably only borrow 200,000, right? So I need to find something within that price range. So I look at something like this, 149,000. Oh, I go to the university. I can rent it out to some of my buddies. I can rent it out by the room, X, Y, Z, and the other. So you look at it, and this is maybe not the greatest example, but say it's a 2-bedroom. It looks like it's an ADU or something like that. A 2-bedroom, 1 bath. Okay, so I'd come here and just to do the math, I'm like, we got 2 bedrooms, 1 bath, and how much can I rent a bedroom for? Well, this is Ohio State. It's pretty expensive. I didn't understand the location very well. And so I was like, I could probably rent it out for, let's say, $700 a month. So if we go back to doing our math, and I'll switch back to sharing my screen with you. If we go back to doing our math, and I erase all this stuff. Why is it not erasing? Maybe it draws. Yes. So we have 2 bedrooms. We're going to say we're going to rent each one out for $700 a month times 2. That's $1,400 per month. Okay. And 50% is typically what it costs, but let's say I'm living in the living room or something like this, and maybe this house isn't the greatest example. But say we fit 3 people in a 2 bedroom house, and I'm one of the 3 people, and I'm getting rent from the other 2, and it gives me $1,400 a month. Sorry, I was writing that and didn't realize I wasn't sharing my screen with you. So I got $1,400 a month. What do I think my actual in this scenario where I'm living here and I can manage it? There are people that I know to a degree, and I'm getting $700 a month per bedroom out of this place. Okay, probably realistically, I'm gonna have 30% is my expense ratio. So I get to keep 70% of this $1,400 per month. So what I can do is I can take the 1,400 multiply by 0.7, which is 70%. So that means every month I'm gonna net basically $1,000. Okay. Multiply by 12. Why by 12? Because we don't look at it based on the valuation based on a per month basis. We look at it over the course of a year because we're in real estate for years. So we take 980, multiply that by 12, 980 times 12. That's 11,000. Write it over here, 11,760 per year. Okay. What is the return that we want on our money if we were to pay cash? That's called cap rate. So we can take 11,760. And what are we going to divide by? Like I said, the amount that we want to make on our cash. Let's say we want to make 5%. So we take that, we divide 11,760 by 0.05. That means that this house is worth, we divide this by 0.05, it is worth 235 200. So 200,000 or $235,000. Let's go back and look at this house. That's what the math says. If we want a 5% cash on cash return, or a 5% return on our money, assuming we're paying cash, we could pay 235,000. So let's go back and look at this property. Okay. Now we need to start asking questions. Here's the questions we ask. When I look at this property, there's 35 photos to click through. Look through all the properties, man. Look through all the pictures. Ooh, that picture looks nice. Looks like it's nice on the inside. Nice. Yeah, it doesn't look like a crap hole. Somebody took care of it, new floors, yada, 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 yada. But the question we're asking is, do we think we can get $700 a month out of a bedroom per bedroom? Look at the square footage of it. 708 square feet. That's tiny, man. That's like a 2 bedroom apartment. Could you? Maybe. Probably not. This square footage thing right there would kind of worry me. But even more important than that is to look at the location. Let me see if I can pull up this location. Waiting for it to load. Okay, here's 71. That's a highway. What is this neighborhood? Okay. If I'm in college and I'm trying to get my college buddies to live with me, that is a far distance from Ohio State. So I started off with price and it got me to the other side of this highway. This highway, if you know Columbus, if you know this area with Ohio State, the further away, obviously, that you get from the university, the less of an appeal that you're going to have to to these students. Okay. Especially on the opposite side of this highway. And then when you're actually there in real person, this is all junk. So at first I look at price because I'm thinking, what can I actually afford? Well, I can afford 150,000. Ooh, this house looks nice. You know, it has new siding on it. It has new windows. It's already done on the inside. But then its location is terrible. Its size means that we probably can't get the numbers that we're estimating that we want to be able to get. Okay. So the numbers probably looked crazy when I was going through it, but you're going to have a lot of experiences or a lot of times where you're running through numbers and you don't really know. Okay. And it might be crazy. It's possible to do a first pass that isn't right. Probably your first pass isn't going to be the final numbers or the final understanding that you're going to get of a property when you're looking through it. Okay. But yeah, this is a terrible location, especially if you're trying to get students here from Ohio State to rent from you. They're not going to rent this, even if they're your buddies. Okay, there's no easy way to this side. Plus, you're kind of in a bad area of town, uh, even though you're not very far from Ohio State. So you'd see that. Okay, what do you do now? Well, what I recommend doing is probably not interested in this property based on its location. Because what's the one thing you can't change about a property? It's location. What's the most important thing about a property? It's location. Okay. You can put a new roof on, you can put new siding on, all that stuff can be fixed, but its location is very hard to fix. But what do you do, especially when you're starting out, is go back to your numbers and you say, okay, I was wrong. I don't think I can get $700 a month out of it. Okay. Or you might say, hey, I don't like this five cap because the area is bad. Say, heck, I might be able to get $700 a month per bedroom out of this house. But based on its location, it's going to be a lot more work because the clientele isn't exactly the clientele that I want to work. So I need a better return. Okay. What type of return would you need? How much money would you need to make in order to take on a project in a not desirable location? A lot of really good investors would say, I'm not going to. But like we've said before, real estate's a numbers game. So at some number, it becomes an okay purchase. Okay. It is possible to buy properties in the hood and still make money. It's just a lot harder. It takes more of your time because it's more labor intensive. It's a higher risk investment. So if it's a higher risk investment, I need a better return. You might say, hey, I want to make 15% on my money because the location sucks. If I'm even going to mess with it at all. So let's say, heck, we could probably get $700 a bedroom out of this thing. I don't know if that's true. I really don't know the market there, but say it's true. Let's keep everything else the same. 30% expense ratio because it's a new house, so there shouldn't be any maintenance issues. So basically, we just stack a little bit of that cash away for future maintenance expense. There shouldn't be very much ongoing maintenance expense and a little bit of management, okay, and a little bit of turnover. So I need a 15% return because it stinks. Let's go through the math again, assuming that we're going to get the same rent. Let's take that same 11,780 was it? I think 780. Let's divide by 0.15. That means that this house, if I want a 15% return, it's not worth this $235,000 to me. It's worth 78K. Okay. Here's another thing. Here's another way to look at it, or a different way to look at it. Assuming that this is all, we're going to keep all this up here. I'm going to say that that stays because it's correct. Another way to look at it is they're asking 150 for this place. So they're offering, we can do the math and we can figure out what type of cash return they're offering, assuming that we're, 100% full and that these numbers up top are correct. We can take, so we can take the amount that we're going to make, that what's called, this is called the NOI. So that's a real estate term you need to know. Net operating income. That's your top line, take out your operating expenses, and what you're left with is your net operating income. So you take your NOI and you divide it into the asking price that they're wanting. And what that comes up with is the cap rate that they are offering. In this case, the cap rate that they're offering is about 8%, 0.08. Now, these numbers might be crazy, okay? They might not be right, okay? But that's how you do the math. That's what it looks like, running through the numbers on a single family house in this example, okay? From there, now that you know the mechanics, you need to underwrite, that's basically what this is called, is underwriting. You need to underwrite 100 deals before you do one. Before you even make offers, man, you got to underwrite 100 deals, because what you're going to do to justify $700 a month per bedroom is you're going to go and look for rentals around here. You're going to say, what is the rental rate? Is 700 correct? Or is that way too high? It might be 350 a bedroom. I don't know. But that's basically the process that you do that. And to get really good, you look at a lot. There's no way around it. You just look at hundreds of deals, literally. And that's how you know. But if I was going to look for just a house to invest in this area in Columbus, Ohio, because I'm targeting students around Ohio State, what would I do? I care about location more so than the price. I will figure out how to come up with the money. So I'm going to look a lot closer, anything that's within walking distance of this university. And the price can go up, but that's fine. The competition can go up, and that's good. Competition might be low out here and fierce here, but fierce is better than low competition. Why? Because easy to get, hard to get rid of. Hard to get, easy to get rid of. It reduces your risk when you have lots of competition, lots of demand. And that's the basics of it. And this is assuming we're just looking at these, single family rentals. Now, that's how the math goes. And I'll give you an outline of what that looks like. We'll go over it right now. Let me switch my screen. Here's the outline. Here's the formula when it comes to doing the math on real estate. It goes like this. You take your rents times number of units. Okay. Then you multiply by your occupancy percentage. Why? Because you're going to have turnover. People move. Okay. Units sit empty at some point in time. Then you're going to multiply, or you're going to subtract. You're going to subtract out your operating expenses. Okay. What is operating expenses? Your maintenance. This is maintenance. Any utilities. Hopefully you bill the tenants for the utilities and you're not paying for them, but that's not always the case. Your insurance, because you have to insure the property. And then your management. Okay. This gets you, once you get all through that, gets you to your NOI, net operating income. Notice what I didn't put in here. If you borrow money, I didn't put in debt. Your mortgage payment, it does not go in here. Your debt or your mortgage payment goes after your NOI. So take a screenshot, write it down. Probably write it down because my handwriting doesn't look that great. I'm writing on an iPad. So we're going to start. I'm going to erase this and I'm going to show you what we do with the NOI. Okay. So we erase this. So we're left with our NOI, our net operating income. That's what you're left with before you pay your mortgage payment, your debt service. This is part of how we get our cap rate. So if just a bland number, say we have $100 of NOI, okay? We have $100 left to pay a mortgage payment with, okay? Now, and that tells you if the deal is cash flow positive or negative, okay? If you're just paying cash, then your return is just this NOI number. But if you're borrowing money, which is one of the big reasons why you want to buy real estate is because of the leverage aspect, you're going to have to figure out my NOI minus my debt service. Okay. So for example, let's say you have $100 of NOI again. Okay. And my debt service, my mortgage payment is 50. Subtract that, I'm left with 50. It's 50 divided by whatever my down payment is. That's what gives you your cash on cash, your COC. That is the actual return that you make after using debt. Now, we're getting a little bit into the weeds here. The bank, when you borrow, especially in commercial, they're going to want what's called a debt service coverage ratio, DSCR. Okay. And they probably want it to be equal to at least 1.25. What does that mean? That means they want to make sure that this payment here maybe that's the wrong way to go with it. They want to make sure that you have 100% of their payment. So you have to make at least, in this case, if their payment is $50, you have to make at least 50 plus 25% more than 50, right? They want to make sure that you're making more than enough money to cover that $50 payment, if you're following what I'm saying. Anyways, if you don't understand that, if you didn't follow it, rewatch this. And if you still don't follow it, watch another one of the videos that I'm going to put together, and I'll keep explaining this over and over. We'll keep going through and doing the math. This is literally how I learned. I went through the numbers again and again and again. I did the calculation that I showed you with the formula. I said rent times number of units. I subtracted out my vacancy. I subtracted out my maintenance. Subtracted out my insurance. Subtracted out my management. Okay. You might say, hey, Steven, I'm going to manage it myself. Do you like to work for free? I've literally had to say that to some of my friends when they're looking at single family rentals. They're like, I'm going to manage it myself, so I don't need to factor this number in. Bullshit. Do you like to work for free? No, I don't like to work for free. So you factor it in. If the numbers don't pencil, the numbers don't pencil. Do not fudge these numbers because that's how you get in trouble. Do not fudge these numbers because that's how you get in trouble. Let me say it once more. Do not fudge these numbers and make sure that you have vacancy, you have maintenance, you have insurance, you have management. Because even on a single family rental, you will have vacancy. Okay. Why? What do I mean, Stephen? What do you mean? You have one unit with a single family rental. Okay. With the house that we showed. Yeah. Theoretically, you have two units because you have two bedrooms, but realistically, you have one door. Okay. You have 12 months that you're collecting rent, which means you have uh, 12 items to sell, basically. You have 12 units of housing to sell, okay, or to rent, whatever you want to call it. What happens if they move out at month 11? Here is that spot. They move out in month 11, okay? So you have 12 total months. You have 12 total months of inventory, is another way to say it. But you only sold 11. What's 11 divided by 12? You're 92% occupied in this scenario. Okay. You have 8% vacancy, the single family rental. Okay. This will happen with a single family rental at some point in time. Why? Somebody's going to move out. Somebody will move out, or they'll stiff you for the rent. That happens too. Okay. So let me show you what type of math changed my thinking or my view and really just altered everything. And it honestly is how Rust Belt Capital and it started the foundation for what became Rust Belt Capital. We've been invested in multifamily real estate for a fair number of years now, and this is literally the reason. Okay, if I have 60 units and one person moves out, so let's say everybody else stays in it for 12 months, but one person moves out, and they're out for an entire 12 months. So I have 59 divided by 60. So I've rented 59 units all year. I had one unit empty all year, and I have 60 total units. What is my occupancy? 98%. 2% vacancy. Okay. Meaning with 60 units, I can afford to not rent one unit the entire year and I'm still good. Now, here's the crazy thing. When you do that math that I was talking about, you take your rents, you subtract out your vacancy, you subtract out your maintenance, you subtract out your insurance, you subtract out utilities, you subtract out all of that type of stuff. The vacancy part, when you're on commercial, on multifamily, so above 5 units, but say in 60 units, our initial thought is that our occupancy is going to be, if it's in a good area, 95%. Meaning, go back to that. Go back to the 60 units. We're estimating that we're only going to have 57 units occupied all year. So we're going to have 3 units, or another way to write this, out of our 60. From our initial math, assuming 95% occupancy, we expect to have 3 units empty all year. If we have 3 units empty all year, does it affect what I get paid? No. I still get paid at the end of the month. If you have 1 unit and you sell 12 months or 11 months of your 12-month inventory, you don't get paid for 1 month because you have one unit and you have to cover all of the expenses. Okay. This is risk mitigation. This is riskier than this. It is less risky to own a large multifamily apartment complex with an enormous amount more debt than it is to own one house with debt. Okay. Because as soon as you have one person move out, which they will, because that's how rentals work, you're right now you're at 100% vacancy as soon as somebody moves out. So this is looking at risk, math, risk. Okay. But let's go to something that's even more significant, even more important. If my computer or if my iPad works. Let's take that house example. SFR means single family rental. Okay, I have one unit. Let's say it's a nice ass house and I can rent it for $3,000 a month. This is a nice house. But heck, guess what? This is the rent. But darn, I just realized that my entire neighborhood, all the other landlords in my entire neighborhood, increased their rent by $200 a month. Let's make it even smaller. Let's say it's $100 a month. So we increase rent by $100 per month. Okay. Now we're at $3,100 per month. What changes in your life? You have an extra $100 of cash flow. What about the valuation? Does the valuation change? It's a single family rental? Probably not, because single family rentals aren't valued by this, which is how you need to do the math that I showed in the beginning. The formula is how you need to do your valuations as an investor. But most people look at single family, what we call single family rentals. They look at it not as a rental, they look at it as a home, which has a totally different approach. Like somebody's willing to spend more money and overpay for a house that they're going to live in because they don't need to make a return on their money. Okay. So it can distort numbers. You, as an investor, need to look at your return on your money. What am I going to make by investing in this single family rental? Okay. So there's a limit to what you can pay. Okay. So increasing your cash flow or increasing the rents on a single family rental doesn't affect the value of the single family rental very much. Okay. The correlation is very small between the rent increases and the value of the single family rental because the normal market for single family homes is buyers that are going to live in them, not rent them. Okay. Here's the difference. Stephen, why are you making a big point about this? Okay. So that's single family rental. Let's go look at this multifamily back over here. Let me switch my page. Let me erase this and show you. Back with my 60 unit example. And if you don't get this, go back and rewatch the video or watch. I'm going to put more of these videos out. Watch more of these videos. We'll walk through the numbers. We'll do the math again. But let's go to our 60 unit multifamily. So I have 60 units. Let's say they all rent for $600. Pick a number. 60 times, what did I say? 600. What's that equal? 60 times 600. That's $36K per month. Subtract out vacancy. Okay. We're going to say we're 95% occupied. So now we're left with $34,200. Okay, per month. That's our top line after our vacancy. Okay, now we need to subtract out our maintenance, our management, our insurance, utilities if we're responsible for them. An easy way to do that is just multiply by zero point 0.5. Basically, you're only going to get to keep 50% of this 34,200. I'll write this down. Maintenance. Well, let me just call it operating expenses because that's what it is. That's your maintenance taxes, or yeah, maintenance taxes, insurance, all that type of stuff. That's in your operating expenses. You're left with 17,100. This is your NOI. How much is this property worth? If I give you an NOI of $17,100, your next question is your cap rate. Let's say the cap rate's 8%. So we take that $17,100 divided by 0.08. My bad. Multiply this by 12. Missed a step. I'm sorry. Multiply that 17,100 by 12. So your annual NOI is equal to 205, 200. Take your 205, 200, divide by 0.08. This property is worth 2.565 million at an 8 cap. That means I want an 8% return on my $2.565 million. And I will buy this property because I'm getting an 8% return. Okay. The point now is what happens if we go from this was $600 a month to 700. So 2.565 million is what this property is worth at $600 a month with 95% occupancy, meaning we have 3 units that just sit empty all 12 months of the year. We've factored in our taxes, maintenance, insurance, management fees. We have this $205,200 of net operating income. It's worth 2.56 million to us. What happens if we increase this number, this rent number? We increase rents by $100. We said in the single family example, if we increase rents by $100, okay, even if it's $3,100, if it's $3,000 a month and we take it to $3,100, that's an extra $1,200 a year for us. That's not really life changing. $1,200 is not life changing, and it doesn't affect the value of the house very much because houses are looked at by owner occupants. You know, they're not looked at as an investment as much. Multifamily is. So we increase rents by $100. Our vacancy is still 5%, or 95% occupied is another way to say that. So 700 times 60. This number changes to 42K. Times 0.95 because we're 95% occupied. So this number changes. Let's just round up a little bit to 40K. It's 39.9, 40K, same thing. So 40K times 12 times 0.5. 0.5 is for the operating expenses. Takes our NOI from 205, 200 to 240. Okay. 240,000 is your net operating income by increasing rents by $100. Okay. You were making 205,000. So you're $35,000 a year, $35,000 a year more just by increasing rents like that. $35,000 is a lot more meaningful to somebody than $1,000 or $1,200 in a year by $100 increase. Are people going to leave if you increase the rents by $100? Probably not. Depends on where you are, but for the most part, probably not. Okay, so what happens to this number though? Now we're at 240. Let's divide that by 0.08. So this was at $600 rents. This 2.565 number, a $700 rent. So if we increase rents by $100, this property is now worth $3 million. Okay, you just made, quick math, you just made $450,000 by increasing rents by $100. Basically $500,000. You increase the value of the property by $500,000 by raising the rents by $100. Way more impactful. Stephen, why does this work? Because banks look at multifamily as an investment. Other investors, other people like me, look at multifamily as an investment. Okay. It is valued solely on this NOI, the cash flow that it produces. Okay. Nobody's going to pay $5 million for this, NOI if it's in an 8 cap market. They're not going to pay you 50 million just because they want to own it. Okay. That's unrealistic. It's a 1 in 100, 1 in 1,000 probability that would happen. Okay. So the value of the property is based on its cash flow. So when we increase the rent, we're increasing the cash flow. When we increase the cash flow, we increase the value of the property. The more number of units we have, the less we have to raise the rent in order to get a bigger increase in our value. Okay. So if this was 120 units and we raise rent by $100, just double this. Okay. That's why units matter. The number of doors matter. Okay. Some people are like, the number of doors don't matter, blah, 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 blah. Okay. They're very, 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 very important. Okay. And I personally, our company, we buy mid-market properties. Mid-market properties for us are 50 to 150 at 200 units, but really 100 to 150 is a mid-market property. We would buy bigger than 150, but that's not necessarily what we specialize in. Okay. 20 units though. That's a multifamily property. If you have the option between 20 units or 60 units, and that's all and we're going to say ceteris paribus, everything else held constant, everything else is the same, location is the same, cap rate going market in the rate is the same. 60 units is better than 20. As a matter of fact, if you're in an 8 cap market, I'm just using 8, could be 6, could be 5, doesn't matter. Don't get caught up in the actual number. Okay. I would probably pay a little bit more to get 60 units instead of 20. Now, what you're seeing and what I'm seeing right now, and this is current, you can see this, you can look for this in your market, and you can probably see what I'm saying is true. If you're 4 units, assuming you're looking at that looks like 40, it's 4 units, not 40, 4 units. Okay. Those on a price per door are more expensive than, say, the 20 unit properties on a price per door. Why? Competition. Competition. more people are going after this than going after this, even though this is better than this. 20 units is far superior than 4 units because of the math I just showed you. Why is that? To reiterate, why 20 units is better than 4 units? $100 increase on 20 units increases the value, or the absolute return, I should say, the absolute return more than it does on 4 units. $100 per month more on 4 units is $400 per month more. Work another couple hours. $100 increase on 20 units per month, 2,000. $2,000 more a month. It is the same work to increase rents $100 here as it is there. Another thing, this math here is why it is super important to make sure that your rents are at market rate. Not necessarily because you want the $2,000 per month or the $400 per month, but because it impacts the value of your property so much. So I've been in markets where people are like, I don't need to push the rents. I've already got this thing paid off, blah, 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 blah. And it's like, okay, you might be fully occupied and you're making good money or whatever, but you're $200 per month per unit below what's a fair value for that rent. Okay. Take that 200, multiply it by the number of units, take out your vacancy. Like, this is a lot of money. Basically $1 million on 60 units in the 8-cap market, what you're saying. If the cap rate, this is the last thing I'll say, and I really think it'd be very valuable to go through this this video again, rewatch it. If the cap rate is low, every dollar you increase rent increases the value of the property disproportionately more. What I mean is $100 increase in rent in a 4-cap market is way more valuable in terms of evaluation gain than $100 increase in an 8-cap market. So if you're in Florida, increasing rents $100 adds more value than if you're in Ohio or you're in the Midwest in an 8-cap market and you increase rents by $100. Okay. Now, I said that'd be the last thing I'd say. It's a good point for me to interject another thing. When interest rates go up, we're talking about value. So interest rates have gone up since 2022. They were way higher than they were in 2022. We're in 2024. If you're in this market and interest rates go up, the value of your property drops much more than if you're in this market and interest rates go up. So valuations in the Midwest, in a market that's, 6.5, 7.5, 8-cap market, valuation should not get hit as hard as if you're in Southern Florida, like Miami or something, and you are paying 4 caps. This is where you're getting these 4 caps, or where you're getting 20, 30, maybe even 40% discounts on value. Okay. Because they were expensive. Interest rates go up, you're screwed. Here, you'll get 10, maybe 20%, maybe a little bit more, but probably you're much closer to this number in this market and much closer to, the starting point's 20 here if you're in this market. Okay. Anyways, these are the numbers. Okay. This is how you go through the math. This is things to think about. If you understand this, if you can run through the numbers enough, Then you can go back to what I was saying, go back to watch where, look at this location, it's less than maybe a mile away, but it's less valuable, and how that impacts it. Okay. The numbers say what the numbers say, but then you also have to add in the art factor of it, of you've looked at so many properties, you know what it's you know how real the numbers are. You can read in between the lines. Okay. That's why I say underwrite 100 deals, 100 properties before you make an offer on one, right? Go back to this realtor.com. Literally, man. Let's go back to the listings. Go back again. Okay. Let it load up. Look at how many houses you have here. Look, you can switch property type too. That's I just started on houses because I was thinking about price. So you see this price thing, and you might get tempted to look at this price. Do not mess with the price. Look at all the properties. You want to know what the top of the market is. You want to know what the bottom of the market is and where you fall in between those two numbers. Go here and look at multifamily. Okay. You're not going to find the best multifamily deals on realtor.com, but you'll find those smaller deals probably. Okay. And it gives you practice, 5 beds, 6 beds. Now that could be beds or that could be apartments. It just depends on where you're at. Okay. Um, but you're going through and doing this. Here's a duplex side by side. You're doing this so you learn and understand the market. Okay. I found this let's say that there's 5 units in this thing. I found this 5 unit. Here's what it trades for. Here's the location. Here's what type of rents it gets. Okay. Then I'm going to go back to my spreadsheet, and it doesn't even have to be a spreadsheet, my piece of paper, and I'm going to go through the math. I'm going to go through rents times number of units. I'm going to take out my vacancy, or I'm going to multiply by my occupancy. They're just the other side of the coin. Vacancy and occupancy is just the other side of the coin. Okay. Um, then I'm going to take out my maintenance, my taxes, my insurance, my management. Okay, that gives me my NOI. Okay, how much money could I borrow to still have 1.25%? Okay, that's what a DSCR lender, you see that on forums or whatever. That's what they're going to look for, is that 1.25% or 1.25, which is 125%. Okay, but go through and look at 100 of these. Don't tell me you can't find 100 of them. You can. Okay. Go to a different market then. Look at a couple different cities, because you just want to practice going through the numbers. And then compare the number that you come up with. Take the NOI divided by the cap rate, compare that to the list price. Okay. Maybe this list price is crazy. Maybe it's cheap. Then ask, why is there a disparity? Are your numbers right? Or are they wrong? Did you make something wrong in the calculation? Maybe they're just asking way too much money for it. Okay, right now in the market that we're in, it's not unrealistic that on multifamily or rental properties, they're asking way more money for the property than what it's actually worth. That's on multifamily properties. But in this market right now in 2024, it's also possible that with single family properties, the ask price that you're seeing is going to be lower than the actual end result of what they actually sell the property for. Depends on your market, but in a lot of markets, they're still getting bid over. Okay. But that's the difference between single family and multifamily, and just so that you're aware, some more current information, current news, because it's helpful. Let me share my screen with you. Is that home prices in the United States just hit an all-time high? They rose 6% year over year. I don't know what they're going to do going forward, but this should reaffirm to you that real estate is still becoming more valuable. Okay. That's how you do the numbers. That's how you look at things. That's how I got started. I went to Ohio State and I looked at properties around the university when I was in university, and literally went through the exercises we went through. I watched other people on YouTube, and I did it in person. I did that for years. I mean, I think 2 or 3 years before I bought anything or made any offer, and hundreds of times. literally, I come home from an internship from a day working, and I'd go through and I'd look at numbers and I'd underwrite just to build confidence. Okay. Come back, use this video, rewatch it as much as you need. Leave a comment. Let me know if this was helpful, things that you'd like to see, what I could do to help you out more. I do this to help you out. Basically, this is like you sitting on a conference call with me that I do every week with people who work with us in our company. But it's just you and me on this. So if there's anything I can do to help out, leave a message in the comment, and I'll try to answer or make a video about it. So thanks.